Hey traders, welcome to the Flow Show Monday morning. We go again. Good morning, Kay. Good morning, Stel.
Good morning. We thought we might have a quiet week for a change, but nope, that's not happening.
Good morning.
How are you
Nope,
guys?
Not at all. I'm all good. How are you?
Very good actually. Got some nice sleep over the weekend, so ready for this week.
Yeah, these weekends are going far too quickly for me. We need some bank holidays coming up.
Yeah.
Yeah, lots going on again. You can't even save a bank these days without it developing into further problems, and we'll touch on that shortly. Over in Japan, apparently the government's going to spend more than 2 trillion yen on fresh price measures. This is fiscal spending to combat inflationary pressures over there. So more than 2 trillion yen going to be put towards that. And we have another appointment at the Bank of Japan, a guy called Shimizu, if I get that pronounce that right. He's going to be appointed as executive director on monetary policy at the BOJ. He's replacing Uchida, who's moving up to the BOJ monetary policy committee, if you like. Now, this guy was a big player when they brought in yield curve control, YCC, and one of his main jobs during that was developing a lot of the steps to mitigate or offset the effects of YCC. So him taking this role keeps him in that zone, if you like, and gives the BOJ someone who potentially can help them out of YCC and moving into tightening of policy should they ever take that direction. So that's a bit of a positive step. Maybe you could point a finger and say maybe a hawkish step. But it's getting the right people around and building the right team to take them out of this easing period. What do you make of that, Kay? Anything we should know about that?
Yeah, he's already he's already been at the Bank of Japan or the MOF and behind the scenes, like monitoring. So he's got a lot of knowledge and at least did a lot of homework on what the effects are of YCC. So it's an interesting appointment. It does show that they want to do something about it. It's very interesting. This appointment. I would say he's going to be a knowledgeable advisor to Ueda and his deputy governors. So it's an interesting development, I must say. That means that they are, as you say, a bit serious about trying to get out of this straitjacket that they've been in for a decade now.
Yeah, it's probably going to go down as one of the greatest escapes if they do manage to pull it off.
Yeah, but again, I mean, he could be advising. An advisor is always works both ways, right? He says like, okay, this is possible to get out of. It's possible to get out of it, but then on the other side, he's probably also going to say, watch out when you get out of it because this could happen and this could happen. So it's always a bit of a double-edged sword or knife, but at least it is. We could say it's a step towards the reforms that they want to bring in. I'm still of the, so far at least, of what I heard about the Ueda, I'm still and his deputy governors, the knowing who they are. It still not be. I think that my base case is still it's not going to be the big reform. But for the market, it may be a big enough reform if YCC gets at least transformed into something different, right?
Yeah, exactly. And what do you make of this? The story in the Nikkei overnight that the Bank of Japan's paper loss on their bond holdings grows to 71 billion. We keep pointing this out that just like we've seen with SVB. Banks who are holding bonds are getting caned because of rates going up. But it's a bit different for central banks holding them, isn't it? Obviously, because in one sense they could just let them all mature and they don't really realise a a significant loss, except on, you know, the
Well,
bean count.
absolutely. The central bank is something completely different. You're not
Yeah.
going to if you push the thought process to the extreme and say like, could a country default because its central bank is losing money? The answer is clearly no, right? It's never happened,
Yeah.
and it won't happen, especially not in the major economies. It's giving the market something to talk about. It's probably giving the bears something to stick their teeth in. If they want to do something with it, and it's likely also being part of this big push to try and break the 10-year yield band. But I think in the end, it's not going to change a thing about what's going on in the central bank or how they are going to view these losses. If you get out of the YCC and you allow yields to creep up, the losses will only get bigger of what they have on the books until they mature, and then all of a sudden the balance sheet will look a bit different, and those losses will have by magic disappeared.
Yeah. Do you think that 79 billion? It doesn't sound even that much. You know, if they were effectively to get everything today, 79 billion for a central bank.
Yeah, we've got like how much
amount.
is it? 5 trillion or so on the books.
Yeah. I would have thought it might have been a bit more, but obviously it's a changing situation, and a book loss is one thing. What you get out at is another. But it didn't seem that big.
In a way, they've done a better job than the S&P, right?
Yeah, and probably
Who's
a lot.
who is actually more of a hedge fund central bank or a central bank hedge fund than a real central bank.
Yeah, they play both sides of the market. Right, over to the RBA, and RBA's Kent says that it's likely to take longer than usual to see the full effect of higher interest rates on households. The RBA is very conscious of the challenges facing borrowers from rapid rate rises. That'll feed Paul's thoughts over at the RBA. In Germany, we had some PPI data this morning, and it's looking quite soft, but not as soft as perhaps expected. PPI coming in minus 0.3% on the month versus minus 0.5 expected. Year on year, not dipping down as much as expected, 15.8 versus 14.5 expected and 17.6 price. So moving in the right direction, but not coming down wholesale as much as the market expects. The ECB, Kazakhs says that the ECB is nearing the point where there is a risk of hiking too much, but then says, because that was quite a dovish comment from one of the big hawks, then says it's easier to repair hiking too much than too little. Inflation is still very high, and the ECB isn't done on rate hikes if the baseline holds up. So the buzzword from this meeting is the baseline holding up, which is what the Guard said as well, that they will potentially get back on the hike cycle if we get over this hump and everything underlying inflation and so on remains the same as it is now. Need to keep an eye on some political risk in France because Macron is going to be facing a no confidence vote over some pension overhauls. It's very low risk that he actually loses that vote, given what I've been reading this morning. But the market is a bit antsy at the moment anyway, so it's not going to take much to throw it around if we get headlines along those lines. Anyway, regarding all the banking stuff at the moment, a lot of countries, entities, authorities coming out saying that things are not too bad. ECB supervisors on Friday said they see no contagion to the Eurozone from the bank turmoil. Germany's BaFin said German financial system continues to be stable and robust. And a US official said US banks have limited exposure to Credit Suisse after reducing exposure in recent months. We'll get into the UBS stuff in a moment. But looking back at SVB, and there was further news on Friday, their parent group, the SVB Financial Group, filed for bankruptcy protection. And apparently there were alarm bells ringing at the Fed months ago as they changed over the team of people examining what was going on at the bank. These new, they call them examiners, Fed examiners, say they fired off a series of formal warnings to the bank's leaders, pressing them to fix serious weaknesses in operations and technology. And then late last year, they flagged a critical problem that the bank needed to improve how it tracked interest rate risks. And by and large, looks like they did absolutely sweet FA about that. Are we surprised still that the Fed seemingly had this flagged up earlier, but the bank didn't do really anything about it?
I'm not surprised about anything anymore. I really don't know what to say. You know, we all saw what happened in 2008. I witnessed it firsthand, and it's supposed to be 15 years of repairing, right? And deleveraging and repairing balance sheets and risk controls. And well, what can I say? It doesn't seem to be. And you know, I said this last week, and I'm going to say it again. You know, do I think this problem, this banking crisis, whatever you want to call it, is it contained? No, I don't think it is yet. You know, you have all these troubles about tier one assets getting marked to zero, Credit Suisse assets, and you know, there's going to be ripple effects everywhere. I think eventually, of course, so you know, when all the central banks step in and they do what they do, you know, they increasing dollar swap lines, they're lending. The central banks are lending to the banks, you know, big amounts like this and B. You know, in the end, they're going to fix things. I know fix is a bad word, but they're going to stop the contagion. But I don't think we're done yet. You know, I'm very cautious about the whole thing because we know how much one bank depends on another. There's a lot of interdependence, you know, cross bond holdings, cross everything. So I don't want to be, you know, scaring people. I don't think there's going to be a 2008 crisis, and I don't think so. But I think we're not done yet with the big headlines and the consolidation. There's going to be a lot more consolidation, I think.
Yeah,
but I don't know what to say, man. I really don't know what to say.
I think it's a mix between 2008. It has some allures of 2008, but then it's got a lot. If you take the mix of both, it's got a lot similarities with LTCM back in the end of the 1990s. And I really, when you say that they have to get rid of all the assets, get rid of all the investments, get rid of this, get rid of that, and then the shareholders are left in the cold, not even having a say in for instance UBS Credit Suisse. As I think potentially the UBS Credit Suisse thing will have, but in my opinion at least, being an older fox, may have a bigger impact than SVB somewhere, because we have seen a very swift move by the depositors in SVB and all the other local banks to the bigger banks. There may be actually some positive again for the bigger banks, but Credit Suisse is a different animal, right?
Yeah.
Thing is, I mean, UBS. I mean, if you look at it on the face of it, UBS, they made an absolutely monster deal. I mean, it's a vulture, a real vulture's deal. You pay 3 billion Swiss, is it, for a bank where only the local bank in Switzerland, take away all the investment bank and wealth management, is worth over 10 billion. And,
plus what is it, 9 billion loss guarantee or something like that?
And they have 100 billion liquidity lines. They have 9 billion loss guarantees. And whatever else. I mean, it's incredible. It's incredible, the deal it is on the surface, of course, because they will have costs. They will have big costs to rationalize everything. But it's absolutely on the face of it a stellar deal.
Yeah, as you say, they paid 3 billion Swiss francs for Credit Suisse. They assuming up to 5.4 billion in losses. As we're talking about these bonds, 17 billion apparently is going to be written down to zero. These Credit Suisse bonds, these AT1s, and the rest. And yeah, liquidity assistance is going to be 100 billion Swiss francs available to both banks while they go through this. And remember, it was only 50 billion that they put up last week. So yeah, I mean, UBS saying no when this first kicked off with Credit Suisse, you know, they were asked, you know, are they going to be looking at taking over Credit Suisse? And they said no. And quite frankly, why would they say yes? They could let, and they have let, Credit Suisse implode, and now they've picked it up on the cheap with a ton of sweeteners from the authorities. And yeah, it's a good situation to deal with. It's a proper bargain hunt they've done there. And you know, they're going to get supported from the authorities, so it should shore things up.
That is the main message.
Yeah, but you know,
Switzerland wants to remain Swiss. That is the main message, because there were, whether it's official or not, there were takeover bids and people thinking about getting in there. And I'm sure if we would have let the Saudis or Qatar do, they would have come and bailed it, or not bailed it out, but bought it over. But I think the Swiss government said to the SNB and to the regulators, now get this done. Told UBS to get it done. Gave him like a lot of sweetness in the deal, and then they want to keep Switzerland Swiss.
Yeah. Now it is a big issue, because what's caused the panic this morning is this 17 billion write down of bonds, effectively holders getting zero. Now these are quite high yielding bonds. You know, this is top level stuff we're talking about here. And as Mark in our chat room, he's top man for knowledge about this, far more than I am. And this has caused wobbles, because now people are thinking, well, you know, if this one bank has gone down, a big bank's gone down, and I'm holding this sort of paper, you know, why am I going to be holding that risk? Why do I want to take that risk while there's other banks that may be in trouble? So that's causing this latest round of worries and market moves. And it's really like, I compared it to, you know, like the cartoons where, you know, someone, like, you're in a ship and a leak springs and you stick your finger in it, and then as soon as you stick your finger in that, another one happens, and then you stick your finger in that and another one happens. And this is what's going on at the moment in markets. You know, I don't think we're at 2008, 2012 levels with this. Yes, there are ripples happening. Yes, there are ramifications, but overall the support from central banks and governments are still there. They can't cover everything, and I don't think they should be covering everything. But I also expect that somewhere soon we will probably hear something about these bondholders getting some form of sweetener, at least from UBS, because if you shut the door on this type of bond moves and bond market, banks are going to shoot themselves in the foot with this. It's closing off an avenue of funding that's a very important avenue of funding. So I don't think they're going to let this slide, and bondholders are going to end up with zero. As I say, because it's just going to shoot themselves in the foot and create further ripples down the road. So I'm expecting perhaps to hear some headlines coming down that these bondholders will get something, whether it's a new share deal, whatever, preference, higher yields, something, protections, I don't know what. But I think it's going to be another situation that's going to be solved, and then we move on to when the next leak pops out. Just to answer, go back, Gear says, what if the ECB lose on the book? Is it really not normal central bank? What you got to remember is that these central banks are printing the money with which to buy these bonds with and all these assets with. Okay, so there is no effective loss for them. If I have £10 and I create another £10 out of thin air, lose that £10, I'm still got the £10 I started off with. You know, I've lost something I've invented, pulled out of thin air. So it's obviously a bit more complex than that, because governments own the central banks effectively, and so on and so forth. But you've got to remember the situation is they are printing their own money to buy this stuff. So any losses are largely immaterial in the real grand scheme of things. So, you know, it's different to a firm buying up and losing money on positions. Central banks are a whole different ball game. But anyway, moving on. And the Wall Street Journal had a piece saying that dozens of banks may have similar risks to Silicon Valley Bank. This was a bit of a scaremonger story, if you've seen it. This was based on some bunch of economists who are doing a bit of 2 + 2 = 5, and saying, you know, there could be big risks and other similar situations as SVB, but it doesn't take into account any other form of hedging and whether the market and these other banks have hedged, not hedged, whatever. So it's a bit flaky in its determination, but obviously clickbait on the headline. So part of the measures that banks and governments are putting in place is that they've announced new liquidity measures, and basically, well, I say new liquidity measures, they're tinkering with the old liquidity measures. Central banks have had swap lines up and running over the last decade or so to provide liquidity to the market, so mainly for dollars, and more recently they've been running at weekly events. So if you need dollars, you go to one of these auctions and you pick up some dollars at a set rate. Now they've switched that to running daily auctions, just to help with the liquidity problem. But one of the effects of it, and the Bank of Japan saying that pretty much there's no problem because they received no bids in their first dollar supply operation, daily dollar supply operation. So nothing jumping out yet that anyone needs any form of extra liquidity, but central banks are opening the door for that anyway. And coming back to other central banks, economists apparently no longer see ECB rates to reach 4% after all this bank stuff. It's part of all these expectations of central banks that have been flying around up and down. They've been the last couple of weeks. Well, now some no longer see the ECB reaching 4%. We already knew last week that the likes of Goldman Sachs, Morgan Stanley all pulled down their ECB forecasts. Some were looking at another 50 pip hike. Now they're saying 25s, but generally the market is bringing things down. However, EconoStream had a piece out late Friday from one of their ECB insiders saying they would support another 50 pip hike in May unless the economy or core inflation softens. We're likely to know who those are. One of the arch hawks over there, probably someone like Kazakhs or Casimir or someone like that. Further data we got on Friday, let's get that up there, from the US. The Michigan numbers coming in a little bit soggy when this calendar decides to update. While we're waiting for that, I can give you the numbers anyway. The headline number came in at 63.4 versus 67 expected, and a previous 67 as well. Current conditions dipped quite a bit to 66.4 versus 70.5 expected. The big news though was in the 1 year inflation that dropped to 3.8 from 4.1, quite a move in terms of this one, and the 5 to 10 year inflation dropped to 2.8 from 2.9 prior. So a little dip there in the inflation numbers. Overall, the data in the US, it's looking a bit mixed again. Manufacturing's not looking too good. Housing had an improvement in February. We've seen jobs still ticking along, that strong NFP the week before. And also the jobless claims looking okay. Retail sales were a little soft. So really got a mixed bag on some of this data. But those inflation expectations will be looked at by the Fed. Could play into thoughts for their upcoming meeting this week. And on that, a Reuters poll said the Fed will stay the course with a 25 pip hike this week. 76 of 82 economists saying they will go with the 25 BP hike. 5 others expect them to pause, and Nomura is still the only one going with a 25 pip cut. 56 of 64 economists said there would be at least one more 25 pip hike in Q2. Now, our old mate Timmy Leaks, the WSJ's Nick Timiraos, said the Fed decision on 25 pips or hold will likely be determined by the market's response in the coming days. That's to all this banking stuff going on. So he's said to be the Fed insider, and he's saying that it could be a close thing between pausing or going 25. Early thoughts on the Fed, guys? I know, Stel, you're going for a hold.
Well, I don't know. I know it's like Cayman says, it's a very different thing between monetary policy and other measures that they can use. But if this environment continues, and if the uncertainty continues, I don't know. I think they're going to cave eventually, but the Fed is the Fed. They can surprise on either side, but I just think that if this situation persists, they're going to hold. Because at the end of the day, if things turn out to be okay, they can always say, okay, we held for a meeting, we can keep going now. There's no, actually, it's a tough one. Could they lose credibility? Yes, but then they try to save the system. So, yeah. If you ask me now, what do I think they're going to do? I think they're going to hold. I don't think it's probably the right thing to do, but I just don't trust the Fed that much. So I think that's what they're going to do. I could be wrong. I said the ECB would be doing 25, and it actually is the one thing they were not considering at all. So so there you go.
Yeah, I'm in a camp. They're gonna go 25. I think for the same reason the ECB did, that they're going to make a clear line between monetary policy and financial policy, just you can see from the rate odds there currently, it's been a complete flip around again. The market by this metric pricing no more hikes from the Fed, no more from the ECB. Even the Bank of England, which is expected to hike 25 pips this week, is suspected to be unchanged. So these rate expectations all over the shop. Kay,
let me ask you this before Kay comes in. What do you think the ECB would have done if it was I don't know, Deutsche Bank or SocGen or BNP in trouble? What do you think they would have done last week? You think they would still have gone 50?
That's a good point.
I find it very difficult.
I would say yes.
You think so? Okay. Yeah.
Yeah, and the reason, and this is a case I made last week, what was the point of them developing all these tools and stuff if you're then going to have to use monetary policy to admit that your tools aren't working?
Yeah, because the tools are, well, it's more about confidence, right? And instilling confidence in the markets, because you know how it is. You might have 100 tools and you're going to say, yes, we're going to do this and that. And, you get a chain reaction from the events. You get depositors getting scared. I don't know. Yeah. I don't know. So
let me throw it back at you then. Everything that's gone on, even with Credit Suisse, even with these bondholders getting smacked today and whatever, do you think the financial system is in trouble?
Not yet, but I'm not saying that it's out of trouble at the moment. That's
no, I'm not saying that either. I'm just making the point, if you have to look at the big picture, is the financial system in trouble again, or are we just seeing some pretty serious stuff going on?
Just Credit Suisse failing, right?
Credit Suisse failing, picked up within 2 days. SVB failed, UK arm picked up within a day. It's.
No, I don't think the financial system is screwed. No, not yet. At the moment, it's exactly like you say. We have events which are being handled.
Yeah, I think until that changes, until it gets to a point where they're not handled, I think you've got to side with the fact that this is some, potentially short-term big noise. But the bigger picture says that everything should be fine and dandy down the line. We shall see. Kay, what are your thoughts on early thoughts on the Fed?
My base case is 25 BPs, and they will say something about QT. That's where they can. That's where they can manipulate the liquidity, and we have seen, as we have already said last week, end of last week, we have seen that their balance sheet already, half of what they did in QT is already gone, just because they injected, what is it, 335 billion or so dollars into the system.
Yeah.
And I think raising another 25 won't change much, but it will give the market and tell the market and the public that they are still serious about inflation. But then QT is where, or QT, QE, whatever, the Q-tip is where they can manipulate liquidity in the market, right? And I think we've got a bigger chance of seeing a move there than I think on the rates, in the rates sphere. And in reply to what you were asking or saying about Deutsche Bank, BNP stuff, I do think that would have changed ECB's approach quite a bit.
You do or you don't?
I do.
You do. Okay, yeah.
I do. I do. I mean, Credit Suisse, don't forget, Switzerland is not part of the EU, is not part of the countries that ECBs are responsible about. But if you have Deutsche Bank or BNP Paribas, that's a different story. And especially, one has to know that BNP Paribas is virtually the government and the Banque de France's main advisor. They and I know pretty well because it's my ex-employer. All the heads of BNP Paribas have been on the board even of some how should I say, some entities of the central bank, the government for sure. So I think if and I can imagine Deutsche Bank is the same thing in Germany. So I think if something would happen to one of those two, it would be a different game of panic, I think, in the Eurozone.
Yeah.
So but that's just my personal view, of course. And ladies and gentlemen, I will have to leave the show right now because my youngest one was over for Mother's Day yesterday. I need to drop him back at the station. So have a safe trading day and week, and all the best to everybody.
Yeah, thanks, mate.
Thanks, Kay.
Cool. Well, good news for Stelios and his lot, because his ECB member Stornoas says Greek banks' exposure to Credit Suisse are almost zero. That's just popped up. So, yeah, no skeletons over in your closets for now. And there've been plenty in the past. But,
yeah, the problem that Greek banks have is that they have a lot of non-performing loans still.
Yeah,
they've been trying to get rid of them for almost a decade, and it's still an issue. But yeah, let's not get into Greek banks. It's full of skeletons there.
Yeah, we might be able to swap some of those NPLs for some AT1 bonds, mate. So geopolitics, we've got this Russia, Putin and China Xi to meeting today, tomorrow, and potentially issuing a statement. Xi has also been out saying that China is ready to guard the world order together with Russia based on international law. Very comforting. He expects a new impetus to Russian-Chinese relations from his visit to Moscow, and is planning to discuss all international issues. So this is going to be a heavily watched meeting between these two guys this week, to see whether Xi is going to make comment on Putin and the war, and whether he's going to try and play peacemaker, or he's going to give Russia the sort of thumbs up in a roundabout way to carry on. That could be a big event for risk, depending on which way that falls as it comes out. As if we didn't have enough big risk going on anyway in the market. So that's it from the headline front, unless, Stel, you've got anything you want to chuck in as well?
No, not really.
Cool.
You covered it.
Yeah. So what are we looking at today then? It's another day of dodgy bond moves in the market. We've got 1-year yields on the slide again, 2-year yields equally looking as weak as well, down to 3.75%. This all comes in the Fed week, where potentially the bigger news is not perhaps going to be the hike amount or whether they pause or hold, but where the Fed see rates going on their dot plots. It is a updated predictions meeting, so we're going to get those dots, and so that's going to be, again, I think the most important thing. I think the market isn't going to get overly hawkish on this, even if the dots move up rates to sort of 5.5%, 6%. I think any jump in yields we get is going to get hammered pretty hard, because the market is not going to let all this go just on a hawkish Fed, even if the Fed say they're going to continue business as usual, much like the ECB. So potentially, I'm keeping an eye on this running into the Fed for maybe an opportunity. Any dollar rallies might be worth hitting on a hawkish Fed if we've still got all these problems ongoing. I don't see why these are going to stop anytime soon. Dollar yen has been absolutely spanked. I very nearly bought this last night on the open when we had all this news about the liquidity, the swaps, the UBS deal. It all looked like risk was perhaps going to do pretty well this morning. I'm glad I held off because it absolutely collapsed. We've gone all the way through this zone I was looking at here, decent support and resistance zone around the 131s, 131.5. At the moment, we're holding below there, which could be pretty significant at the moment. It's going to keep the downside in play. Really, the downside from here could put us back into the 129s, 130s. If you remember, we had this box going on from the 127s up to the 133s, 134s. Below here, we might be seeing another smaller box, and then we'll be looking at whether we're going to get a move back down to these 127s again as we go. So a lot of noise to go on here running into the Fed. These expectations are changing like the wind. 1 minute they're blowing one way, the next they're blowing another. Again, we're in a high volatility environment at the moment, and that's the biggest piece of advice I can give you again this week. Don't trust the techs as much as you would when things are quieter. Keep your risk low, be very nimble. If you get in a trade and see some profit, don't try and shoot for the stars. Take some of that profit on the way, lock in your risk, or reduce your risk as quick as possible in case the market turns on you. It's all about, even if you make a little rather than a lot, you can do that lots of times and still make a lot, if you get my drift. Cable is one I'm going to be looking at this week as well. I think when we're talking about central banks pausing due to this banking risk, I think the BOE is probably the bank more likely to pause because of financial stability risks than the ECB and maybe the Fed. We've got CPI coming out on Wednesday. The market is expecting that to dip a tiny bit. If it's hot, then the pound's going to rally, and we're probably going to see some increased expectations for the Bank of England. But because of I think that they may be a bit more cautious to do these bank risks. They may be very dovish in their message, and we all know that whatever Bailey does, it usually results in the pound falling anyway. So if we get a situation where maybe the CPI is hot, we get a run up to maybe this 124s again, that's been a big solid area. I might look at that for a few shorts to run over the Fed later on that day, because if the Fed do go the 25, if they do copy the ECB and say we will continue with monetary policy because we've got other things to fight other than banks, and they keep that definition clear between monetary policy and financial policy, that should see the dollar gain, and obviously cable will dip down, and then we'll see where we go from there and what to do over the Bank of England. So that's what I'm looking at least from Wednesday, and the CPI running into the FOMC on that side. Euro sterling's not looking too hot at the moment. We've had bounces off the decent tech levels. Last week I was looking at this area, we got the bounce top of the zone, got back into the 88s. That didn't last. It's looking 88.20s to 30s is perhaps where the rally sellers are coming in yet again, as they've done historically. We went through the zone, got down to my next big area, down towards the 87, 00, 15, 20 area, a decent bounce again there, but we've come down very quickly. So I'm not ruling out a move down below this area. If we get below 86.90, that means we should potentially see some further downside. I missed this move last week off of there and kicked myself for it. I'm going to be a bit cautious because we come back down here so quickly. I may have a little trade, short-term trade into this zone here between 87, 18, 15s and the big figure down here. But I'll be out if we get below that 86.90 area. Same sort of play. Look to put some in play, some short-term, and put some in the core long position, which I'm happy to knock out in any rallies. But the picture will look a bit different if we're below that 86.90, and I'll be worried that we go potentially through this next zone around 86.45, 70-ish. It's another big area down here that's been former support and resistance. So I'm going to keep an eye on that one as well. Dollar Mex, I know Kay's had a smasher on this one. He's pretty much nailed the top this morning. He had a bit of a zone up here in the sort of 1920s, 25s. He's hit that, and it's dipped back again. This one is a really good risk player at the moment. You're getting plenty of bang for your buck, big volatility, decent percentage moves. I am a bit cautious that we did break the prior highs up here, which suggests that any risk off, the market is prepared to do more. So again, you've got to be nimble in these trades. If you're getting something, if it makes you money, put some in the bank and reduce your risk elsewhere in case it flips again. As for the rest, not really an awful lot. I'm looking at euro dollar is still looking a bit bullish. It's tapping up against the 107 now as we sit here. We know this level previously. It's been an on-off resistance area. I'm still long from down in the 105s, so I may look to take a bit more off my position in a moment. If we do get a break through 107s, then we got these highs up again, 107.60s. Maybe we get a bit of a push up to the 108s. I'm still not expecting this to go anywhere significant for now, but I'll be led by the price action. Certainly, dips are seemingly going to be bought anywhere down to the 106s, low 106s. Let's keep an eye on that one. Stel, you got anything you want to look at in particular? And asking about silver and
yeah, we can have a look. I'll take it for a few minutes.
Take it, yeah. Go ahead,
sure
mate.
Thing. I was also looking at Dollar Mex, and I was at the gym. I hadn't left an order, but I was at the gym when it hit that 1920, and I completely missed it. I really want to sell that for many reasons. Carry being a big one. But like you said, it's a risk indicator. So, it is a risky trade because it does follow risk moves quite aggressively. But anyway, so 10-year yields, really, really important area now that we're in. We did break the lows earlier today, the previous lows, but we're back above. Yeah, I mean, if this level breaks, seriously, I think we're going back somewhere between 2.5% and 2.75% or something like that percent. But that will mean that the Fed has paused and they have basically given up on more tightening, at least now. But for the moment, this area is holding, and this needs to hold for risk bears, because so basically if this holds and we start bouncing again in yields, then theoretically it means that things have stabilized, which means that then equity indices should continue to move in terms of what inflation is doing and what central banks are doing. And frankly, I'm amazed at how resilient the S&P and the DAX, the Dow and the DAX as well have been over the past year. It is incredible given what's happened that we are still up here, but we are. And I guess the market is trying to anticipate when the central banks will turn and basically start easing again, which means that we just go to new all-time highs, basically. But at the moment, they haven't done that. So, the indices are still trading very well, all things considered. And I was talking with a friend of mine yesterday on Sunday, and they were saying, what do you think stock market's open tomorrow after, what happened with Credit Suisse? And I said, well, logic says lower, but don't be surprised if the gap lower gets bought straight away. And this is exactly what's been done.
Yeah.
So it is, it's very, very difficult to go against stocks, and I mean selling them, because they have been very resilient. If you want to take a risk-off trade, maybe look to do it via another instrument. I don't know. It's a very tough one. So gold and silver. So gold took out went above 2000 and has come back straight after. We did have a previous high here, which was just below 2000, I think. Yeah, we took that out. Really, the main high that's remaining is the 2070. What was it? 2070 highs. That's the all-time high, right? Or
Yeah.
was it up here? Actually, it's not the all-time high. We got to 2100, didn't we? Or something like that. 20. I can't remember, but basically, it's more or less the all-time high. So that's the target, and we are pulling back a little bit from this morning's rally. But my guess is that when New York comes in, I think they're going to start bidding this up. So I wouldn't want to get short gold anytime soon. Maybe get short ahead of the previous high, maybe on a retest of that high. But again, this has been trading really, really strongly. I mean, look at this run over less than 10 trading sessions from 1800 to just under 2000. Well, we did hit 2000. So gold is still looking strong. The RSI is getting a little bit on the high side. So the daily RSI is 70, above 70. So we have to take that into account. And it's a similar story with silver. Silver technically less convincing yet. We're still in this channel. But a break above 24 and a half really is the big level. This will mean if we break those levels, means that the gold has hit new all-time highs already. I wouldn't go against these yet, unless you are convinced that the Fed's going to be doing 25 and it's going to be non-dovish on the statement, and that the central banks are all going to keep tightening without any fear about the banking sector, because they do have the instruments to tackle that, as we said before. Then if you think all that, then yes, you might want to be selling into this rally as we get to some important technical levels. But I am still long silver, now up to roughly $1 on that trade, so it's doing well. I want to add more. Am I going to add above 24, or am I going to add on a dip? I don't know yet. So we will see. But the main move still remains. Yields are a lot lower. Yields are a lot lower, and they've gone lower very quickly. And it's all about central banks now. So if the Fed pauses, then I think we see a general rally in pretty much everything, even cryptos. And cryptos have been doing very, very well. I mean, Bitcoin is broken out now. Yes, we are at a very interesting level, which is a fib, and also these lows down here, which we spent quite a bit of time in late May. So this is a level where we're going to pause a little bit. But as I said before, if the Fed is dovish, I think we're going straight up. And similar story with Ethereum. We broke. Well, I had this trend line here, but really it's an area here around the 1900 to 2000 level, which is very important. It seems that a lot of instruments are aligning, and they're getting into a ranges and areas where they have to make a big decision. The dollar is flirting with the 50 DMA, the Dixie, and again, this was an impulsive move lower from late last year, from 115-ish, 114. down to 100, and now we're correcting, and we're probably going to see another move lower. That's my base case scenario. So I think we're going to see something like this. It's some kind of channel, whatever, and we might go a little bit higher, but I think this is going to resolve to the downside, and the target for that, man, that's quite a bit lower. So that would be somewhere in the mid 90s. But one step at a time. The euro dollar is interesting because we saw that the ECB is still sticking to the hiking, and for all we know, they're still going to be doing another 50 next meeting. So we're starting to see a divergence between the Fed and the ECB, same way as we had the divergence on the way in, with the Fed being early. This same way we're going to have the Fed being early in slowing the pace down and pausing. So this, I think, is going to resolve to the upside. I think the first realistic target is 110. And again, the Dixie is obviously the opposite of euro dollar. Impulsive move higher, correction, and then we move again higher. That's my base case scenario. The cable, I have less faith in the pound at the moment, but against the dollar, I think that it's setting up for another a similar kind of breakout. So I'm not drawing this properly, but this is some kind of corrective. I hate it when I have the magnet on. Some kind of corrective structure, which is going to get resolved to the upside. Norway, I really, really want to sell, and I was waiting for a trip towards the 11 highs. If we get them, I am definitely going to give it a try. Maybe a little bit ahead of that, maybe 1090 or something like that. But I'll wait to see what the Fed does first. And the MEX, we talked about the MEX. I really, really like this on the short side, and that was a really nice sell by K. I missed it completely. If we get towards that trend line resistance, I'm going to try that as well. But apart from that, it's a waiting game until we get the Fed. So and until then, I really think that when the US, they're getting in now, right? I think we're going to see a little bit of equity selling, a little bit of crypto and metal buying, maybe, similar pattern to the last few days, because let's face it, the whole situation is far from being resolved. Yes, the central banks, they have the tools. They've told us they want to do whatever they can, but I think contagion is still a big risk. So I would be very, very careful calling this situation over and over and done. Anyway, yeah. That's what I had to show. I don't really have much more.
Yeah, no worries, mate.
I will wait for the Fed.
Let's see if my screen sharing is working today to take that back. Where am I? There. Can you see that?
Yep.
Wicked. Good stuff. Yeah, Catherine was asking about Euro knock. Looking at shorts, a bit different to some of the others, but we have got a solid area up here into the 1147s, 48s. So if you're looking to short, that's would be your ideal area, because it's proven to be where the resistance is. If you want to look for a break, then you're perhaps looking for a move under this trend line, just from a short-term basis. If you see it holding under there, maybe also getting under this moving average, the 100 hourly moving average, and the short-term ones all looking at similar. So you probably want a confirmation break to get into shorts at these levels. As I say, get below that trend line, hold below that trend line, give you the conviction to maybe have a look a bit lower. But otherwise, really going to be one of waiting for a move back to these highs. But I'll be wary if it goes very quickly.
Ryan, I always want to be shorting EuroNOK. That's what I've done for years now. And but you need to be careful with the entry. What I would say is I would wait for the break of this trend line. Probably a nice little retest would be nice, but really I want to see a lower low. So I want to see it break below 1135. That's what I want to. That's what I want to see. So if those lows get taken out, then I think that's my signal. And if it means I've missed 500 odd pips or however many they are, it doesn't matter for me. That will be confirmation.
Yeah, no, I agree, mate. But like you say, there could be a few pips if you get a break of the trend line and we come down to maybe the moving average, then bounce. If it holds that trend line, the bounce, then
Exactly.
you could look to 11.35, and that's where you look to take some profit and see what happens after that. You can get your stop then down just above that trend line. You've locked in what you've banked already, and then you ask the question: is 11.35? Does it carry on through, or is that where it's going to find support? And then you can mark the trade at that point. Michael was also looking at Euromex. Again, a bit slightly different from Dollar-Mex. It's holding its highs, whereas we've got that fresh high in Dollar-Mex today. So again, it gives you your place to lean against. Call it 2050, 2047, 48, 2050. That's your area. If we're breaking above there, then potentially we're looking at further upside, further problems to come. But then you run into the traffic zone around here, getting up towards the high 20s, 21s. So for me, it doesn't matter what the chart. It's the price action that tells me whether to have a trade or not. It tells me this is a level, and you have to trust your level if you want to do so, and you have to decide how much risk you want to do playing that level. And it doesn't really matter what pair you look at. This could be any pair you like, any asset you like. The price action, the patterns, they're going to be the same all over. Either they're confirming a decent level or they're not. And doesn't matter what the asset is, you can trade it all the same way. Oil is one, just quickly, really still looking very negative at the moment. It tried to have a creep up to this 70 area, couldn't really even get remotely close, and we're back down again. Fresh lows. Where are we heading from here? It could be all the way back down, as you say, the low 60s, 61s, 62s is where a lot of people are looking at as a potential area for where decent support might come in. But we're going to be trading this all week. Again, there's going to be more headlines from banks, maybe something new that we don't know about, other leaks springing in the system. We'll have to keep an eye out. Just quickly, before we shut up shop, the data this week, not a lot today. Tomorrow we get the German ZOO and then Canadian CPI, a couple of bits to look at there. Again, prices in the UK all coming in ahead of the FOMC on Wednesday. Thursday, it's more central bank action. The SNB with their first quarterly meeting of the year. The market was expecting a 50 pip hike from them. It's now chewed that right down to 25. If the S&B, I think, have got this situation under control with UBS, I think that the market may be underpricing what the S&B do there. They've chucked the kitchen sink at it at the moment, got enough liquidity. There should be no reason, based on the fundamentals, why they don't go a 50. So look at that if you're trading the Swissy. Then the Bank of England, some housing data as well from the US. Eurozone consumer confidence flash, forget that. It's been positive 4 times in its entire history. And then we get Japanese CPI later that night. That will be one to keep an eye on for what goes on at the Bank of Japan. And then on Friday, we start hitting the flash PMIs for around the world. So keep an eye on that for Friday. And on that note, we shall call it a day.
Is it Friday yet?
Sorry?
Is it Friday?
Is it Friday? Oh, I wish, mate. It's going to be another long week. So get plenty of coffee in. Make sure you're getting early nights and good night's sleep, because I'll tell you what, I was knackered by Friday morning. I was knackered last week. Yeah. It really takes it out of you. You've got to keep your mind fresh and ready to go. Thank you very much, Dale. Thank you very much, boys and girls. We shall see you bright and breezy tomorrow.
Thank you, Ryan. Bye, everybody.
Cheers, mate.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.